Well, hello there. Feels like there's a lot going on in the world right now, doesn't it? January 2025. What the fuck? Chill, right? We had a prime minister step down, sort of. We saw the start of a trade war with our neighbors to the south, maybe. The Bank of Canada cut interest rates again. And hey, at the rate we're going, by the time you watch this, we'll probably have been invaded by aliens. Question on everybody's lips right now is, what will it all mean for Ottawa's real estate market? Maybe not the question on everybody's lips, but it is something I'm being asked a lot lately in many different contexts. And the honest answer most of the time is, I really don't know for sure, but as you may have guessed, I do have some thoughts for you. And I've also got some stats for you. You know I love those. So grab yourself a hot cup of coffee, pour the coffee out, fill the cup with whiskey, not American whiskey though, and get ready to say goodbye to the next 25 minutes of your life, because this, my friends, is your February 2025 Ottawa real estate market update. Let's go. All right, so we'll touch on the big picture stuff in the second half of this video, but before we do that, let's go over the stats for the month of January and see whether all the madness had an actual impact on Ottawa's freehold and condo markets, shall we? As always, we'll start with freehold. So let's get those January 2025 Ottawa freehold sales stats, that's a tongue twister, up on the screen in 1, 2, All right, quick reminder, freehold property is any property, townhouse, detached, semi-detached, etc., where there are no condo fees, right? So you own the home and the land it's built on. And in January 2025, we sold a total of 408 of those freehold properties in Ottawa. 408 sales is a somewhat low total for the month of January. In fact, it's the second lowest January sales total we've had in the past 7 years. The lowest was 364, and that happened in 2023, in case you're curious. That being said, while 408 is low, it's not what I would call unusually low. In recent years, a typical January sales total would fall somewhere between the low 400s and the low 500s. So we're still within like our normal range here, right? And just to give you a bit of added context, our January sales total was about 1.9% lower than December's total of 416, and it's also about 3.5% lower than last January's total of 423 sales. Now, I don't view either of those drops as significant, personally. And lastly, also on a personal level, I can tell you that the inquiries we get here at the Papineau Group are typically split about 50-50 between buyers and sellers. In January though, it's been almost all buyer inquiries, right? And so we're working with a good number of buyers right now. And the challenge we're having is there's just not a lot of quality supply that's available at the moment, right? Even a lot of these like new listings we're seeing right now, they're just old listings from last year that failed to sell and that are now just coming back to market, right? So like we're seeing an unusual amount of January and February listings with exterior photos that have grass and trees full of leaves and flowers that bloom. And it's just like, oh, that's weird. They must have their own special little microclimate on that street, right? But I digress. In spite of January's somewhat sluggish sales volume, we did see an average sale price of about $773,000 for the month, which is very strong, right? It's about a 2.9% jump up from December, month that comes before January. And it's also a whopping 6.5% higher than last year's January average of about $726K. In fact, this was the second highest average price we've ever seen here for the month of January. And it's also the 9th highest average price we've ever seen here for any month. Now, the fact that a January average is cracking our all-time top 10 is definitely noteworthy to me. In any given year, you'd expect January to have one of, if not the lowest average selling price for that year. And it's also worth noting that we've seen the monthly average selling price for freehold properties steadily trend up ever since the second half of last year now. So, I don't have a crystal ball or anything, but if I was planning on selling a property in 2025, I'd be very encouraged by what we're seeing lately. And if I was planning on buying in 2025, I'd want to make sure I had all my ducks in a row ASAP, as soon as Papineau. Moving on to inventory, and I will remind you here that inventory is not the same thing as supply. Inventory is a measure that accounts for both supply and demand all in one. And in January, our inventory levels stayed perfectly flat, right? We started out with 3.3 months of freehold inventory and finished up with 3.3 months of freehold inventory. Now, what that essentially means is that for the month of January, the supply and demand for freehold properties were perfectly balanced. Now, that being said, 3.3 months of inventory is a relatively low total in the big picture sense. In a balanced market, we'd expect to have between 4 and 6 months of inventory. So anything below 4 months is considered to be an indicator of a possible seller's market. And speaking of market indicators, our sales to new listings ratio for January was about 50%, right? And our average time to sell was about 52 days. Both of those stats fall within the ranges we'd expect in a balanced market. Okay. Now, I have mentioned this before, but in months like December and January, our key indicator stats do tend to get a little wonky because of lower volume and other seasonal factors. That being said, and considering all things, I would characterize our freehold market as like a soft seller's market at the moment. Buyers right now are willing to compete for quality properties, but they're not willing to overpay or get like too crazy, if that makes sense. Did you get all that? Good. And that'll do it for the freehold segment of this month's update. Before we get into some of the stuff we've seen in the news lately, let's quickly run through January's condo stats. All right, we're not gonna waste any time here, so let's get those January condo stats up on the screen for you in 1, 2, 3. All right, I guess technically we did waste 3 seconds there, but hey, what can you do? January was more of the same for our condo market in that, on the whole, it's doing okay, but it's not freehold. If we think of the condo and freehold markets as like siblings, the freehold market is the one that just got accepted into a prestigious university on a full scholarship, and the condo market plays in a band, and it's the drummer. But hey, maybe the condo market will end up getting its real estate license at some point and turn his life around, right? Anyway, in January, the condo market accounted for 174 sales in Ottawa. That's 7 more sales than we saw in the previous month. It's also 16 more sales than we saw in January of last year. So hey, there's hope. For added context though, 174 sales is within our typical range for January, but much like Big Brother Freehold, this year's total is on the very low end of that range, which extends from about 150 to the high 200s. Now, the average selling price for a condo in January was $439K and change. That's about a 2.9% increase over December and about a 5.1% increase over last year's January average. And it also happens to be the second highest January average we've ever seen. But it does fall squarely within our usual range of about 410 to about 455K. And for those who are new to these updates, condo prices here have basically been flat for over 2.5 years now, right? And over that period, our monthly average sale price has predictably landed somewhere around 435K plus or minus 5% for just about every single month. So there's really nothing too new or noteworthy about this month's average. Moving on, condo inventory was also flat last month. We started and ended January with 3.7 months of condo inventory. Now, taken as an indicator, 3.7 months of inventory is just slightly on the seller's market side of the line that separates a seller's market and a balanced market. Sticking with our indicators, in January, we saw our condo sales to new listings ratio come in at 41.1%. That is on the very, very low end of the range for a balanced market. Anything below 40 would actually be an indicator of a buyer's market, right? So our inventory and sales to new listings ratio stats are painting very different pictures right now, and that is because, once again, at this time of year, those stats tend to get a little weird and need to be taken with like a big old grain of salt. All right, so rounding out the condo stats here, there we go, saved it. In January, the average time to sell was 53 days, which also falls within our expected range for a balanced market. And so if you want my opinion, and it would be weird if you didn't and yet still watched all the way to this point in the video, but anyway, if you want my opinion, I'd qualify our condo market as being pretty balanced right now on the whole. Right? Generally speaking, our condo market tends to follow freehold's lead. So if freehold prices continue to rise, it wouldn't surprise me to see like a trickle down effect on the condo market, you know, because of affordability and all that good stuff. So that'll do it for the stats. Now, let's talk about January's very eventful news cycle and how it might impact the real estate market here in good old Ottawa, Canada. all right? And by the way, we're recording this on February 4th in the afternoon. As of this time, Canada is still a thing, all right? We haven't become the 51st state just yet. But just in case that's changed by the time we put this video out, let me just say a very warm howdy y'all to our new overlords. And let me also say that there's nothing I like more than warm apple pie, bald eagles, and Chevrolet pickup trucks. And hey, one other thing, who needs free healthcare when you got Jesus on your side? Am I right or am I right? All right. You gotta be ready for anything, right? All right, let's go. Sometimes you just have to laugh at this stuff, otherwise you cry. Anyway, oh man, so what the hell are we doing? There's three things. Let's get back to business here. There's three things I want to touch on to finish off this month's video. First, we'll talk about the Bank of Canada's latest cut to interest rates, and then we'll tackle the two topics that seem to be coming up in a lot of my discussions lately, and that's one, how this looming trade war with the US might impact our real estate market here in Ottawa, and two, how our upcoming federal election and the likelihood that we will see significant cuts to the federal public service might also impact our real estate market. All right, so let's dive in. We'll start with the more boring of the three here and quickly talk about the Bank of Canada's recent announcement on interest rates. All right, so if you missed it, on January 29th, the Bank of Canada cut its overnight rate by a quarter point, also known as 0.25%. Okay, now this is the sixth consecutive announcement in which the Bank of Canada has cut its key rate, which now sits at 3%. And the overwhelming sentiment is that we are in for a few more cuts this year, right? So what did it mean? Well, if you have a fixed rate mortgage, it means nothing, right? I'm sorry, you do not get to share in this joy. But for those with a variable rate mortgage, this cut represents a savings of about $13 per month for every 100K of loan. So as an example, someone with a 500K mortgage is now saving about $65 of interest per month compared to a few weeks ago. Now, throughout last year, whenever we would have one of these rate cuts, my general view was that the cuts were cool if you already had a variable rate mortgage, but that was about it. At the time, I didn't think the cuts would have much impact on things like transaction volume, housing prices, etc. And the reason for that was that for a long time, fixed rates were significantly lower than variable rates. And so the cuts were not doing anything to increase overall affordability for anyone who's looking to buy. They were just going fixed anyways. It's kind of like having two restaurants that are side by side and that serve the exact same food, only one of them charges $5 for a burger and the other one charges $7 for the same burger. Even if the second place drops their price to $6, you're still probably not going there, right? But that all changed in late 2024 when variable rates came to be basically on par with fixed rates. And that's about where things stand today as well. Okay? And so, unlike last year's cuts, the cuts that we are expected to see in the months to come are now far more likely to actually increase a person's buying power. And when you increase buying power across the board, it often leads to more transactions and higher prices as far as the real estate market is concerned. So, keep that in mind. One other very important note for you on the way variable mortgages work here, and honestly, if you're only going to take one thing away from this month's update, this should probably be it. That or my Texas accent, you pick. The very large majority of variable mortgages here are set up to have fixed monthly payments. Okay, now what that means is that over the course of your term, your mortgage's interest rate will change, but your monthly payment amount stays the same. And so the way it works is that when rates move, it changes how much of your monthly payment goes towards interest and how much of it goes towards principal or equity, right? So if you were to get a variable rate mortgage today, with a monthly payment that was comfortable for you. As rates come down, you will start paying off your home faster while continuing to make the exact same comfortable monthly payment. Right? So over the course of say a 5-year term, you may very well end up paying off 6 or 7 or 8+ years of your mortgage almost by accident. Right? That's pretty cool, right? Also, as rates come down, prices generally tend to increase, so you'd also benefit there, right? And most lenders will let you convert a variable rate mortgage to a fixed rate mortgage at any time throughout your term. So you can always switch it up if and when variable rates start going up again, right? Now, of course, every case is different, but I do think that for a lot of people, buying now and going with a variable mortgage is a better play than just sitting around and waiting to try to like time the bottom on interest rates, right? Just some food for thought. That'll do it for interest rates. Now let's get to the meatier stuff, or let's start with our own government before we get to Big Brother from the South. All right, before this whole tariff war fiasco stole the hearts and minds of Canadians everywhere, one of the topics that was coming up quite a bit in chats with clients this year was the fact that we're going to have a federal election this year. And if you believe the polls, it seems quite likely that we'll end up with a majority conservative government. And when the conservatives do take power, there's this notion that they're going to make some pretty significant cuts to the federal public service. Anyone that lives in Ottawa knows that the public service is our main industry and that the federal government is our largest employer here, right? So obviously a massive round of layoffs in the federal government, or hell, even just the threat of it, could certainly have a cooling effect on Ottawa's housing market, okay? So that being said, here are my thoughts. One, we don't know for sure how the election is going to play out, right? It could be a majority conservative government like the polls indicate. It could also be a minority government, or the Liberal Party could mount the greatest political comeback of all time, right? Who knows, right? Also, if there's one thing I know about politicians, it's that they love saying that they're gonna do stuff and then not doing that stuff. It's kind of their whole thing, right? And so, you know, who really knows what the breadth of these supposed cuts to the public service would even be, or if there will even be cuts at all. I personally feel like this sort of stuff tends to get blown way out of proportion. And if anything, the speculation or the fear of what might happen often ends up being far, far worse than what actually happens, right? Also, personal story here, believe it or not, I have firsthand experience working in the federal government at a time where massive cuts were happening. For those of you who don't know, before I became a full-time realtor 10 years ago, I spent about 8 years working for the federal government. And yes, I use the term working here very loosely, really felt more like babysitting most of the time, but anyway. I was employed by the federal government during the 2012 Deficit Reduction Action Plan, or DRAP, as it was called. Now, the mandate for DRAP in 2012 was to reduce the cost of our federal public service by 20%, right? So like a pretty significant amount, right? And look, there were certainly people who lost their jobs during that period, and I don't want to make light of that, because obviously that's a very devastating thing, right? That being said, the federal government in 2012 was able to achieve a significant portion of that 20% reduction by means other than letting people go, right? There were a number of empty positions that were still being accounted for in the budget, which were just terminated. You had people that were close to retirement who were allowed to just retire early with their full pensions. There were severance packages that were offered and voluntarily accepted by a number of people who, you know, kind of already been looking to get out of the government. There were reductions to the amount of external contractors and temporary employees. There were salary freezes, and then, like, I'm sure a bunch of other stuff that I'm forgetting. The point is, they were able to achieve a significant reduction in the cost of the federal public service while significantly mitigating the number of true layoffs it took to get there. By the way, while all this DRAP stuff was happening in 2012, Ottawa's real estate market fared just fine. Prices ultimately went up by about 1% that year, right? So again, just to be crystal clear here, I cannot tell you what the future holds, and I understand that just because things played out the way they did in 2012, it certainly doesn't mean they'd play out the same way today, right? Could layoffs to the public sector have an impact on the real estate market in Ottawa? Yes, of course, they could. But in every single one of my 10 years in real estate, there has always been something that you could point to if you wanted to be pessimistic about the market that year. And in my experience thus far, the fear around that stuff almost always ends up being a lot worse than the actual impact. Doesn't mean it'll always be the case, but that's been my experience over the past decade or so of slinging homes. All right. That being said, what about tariffs? What a month. Jeez. Here's the deal. I'm gonna let you in behind the curtain here. I spent a ton of time. I spent some time researching and then writing up this whole long thing about tariffs and how they might impact the real estate market here. And then, after I was finished, news broke that Canada and the US are calling a timeout on this whole trade war thing for the next 30 days. So, I mean, it's good news, don't get me wrong, but as usual, no one thinks about the realtors, right? Like, what am I supposed to do for content now? In all seriousness, much like the majority of other Canadians, I sincerely hope that these tariffs never come to pass, and I suspect most Americans feel the same. We're just better as friends, y'all. That being said, I'm hearing a lot of people talk about how this trade war would cause our housing market to crash, right? That always seems to be like the default response. Something bad's happening, housing crash, right? But the thing about tariffs is that, at least initially, they're inflationary. Just to paint a picture for you, Canada has already stated that if the US imposes tariffs on Canadian imports, then we're gonna pull a reverse Uno on their asses and do the same thing for US imports. And here are some of the things Canada imports from the US to the tune of billions of dollars every year. Drywall, glass, HVAC systems, major appliances, ceramics, primary metals, and hardware, all of which obviously play a huge part in the renovation and new home construction industries. Right? Another important note here is that a number of chief economists with major banks have said that if a trade war were to break out, they fully expect the Bank of Canada will lower its key interest rate even further than anticipated in order to help ease some of the pain caused by the tariffs. BMO, for one, has already revised their prediction for 2025, and they now expect the Bank of Canada's overnight rate to end the year at 1.5%. That's half of where it is now. And then, of course, you'd also expect our government to provide some form of financial assistance to the people who would be most impacted by a trade war. That's just what we do here. We take care of our own, right? So, to recap, if a trade war breaks out, we're likely to find ourselves in an environment that is marked by supply chain issues, significant increases to material costs, super low interest rates, and government handouts. Is that starting to sound familiar to you? It's COVID all over again, right? And we all know what happened to housing prices then. I would like to think that we've all learned some important lessons from the COVID era housing boom, if you want to call it that, and that the powers that be, and also we as consumers, wouldn't just go and repeat the same mistakes. Right? Nevertheless, I do suspect that a trade war would initially put more upward pressure on housing prices than downward pressure. That being said, because housing affordability never really fully recovered from the COVID era boom, and because we now have a far, far greater supply of purpose-built rental housing in major cities, and because also, let's face it, there's just a lot of uncertainty right now, I could also see a scenario in which a trade war causes a significant slowdown of our real estate market, much like we saw in 2023, where prices didn't come down much, if at all, but transaction volume was consistently hitting 10 to 15-year lows on a month-to-month basis. And lastly, it's also worth noting that whenever you're hit with high inflation over a long enough period of time, a recession does typically follow, right? So if a trade war were to break out and last many months or even years, that's where we could start to see some real pain in the housing market and in a lot of other areas for that matter. But here's hoping it won't come to that, right? I'm an optimist. Snarky ass one, but still an optimist. I also like to believe that the folks leading this country, whoever they may be, will be able to help guide us through any turbulence by leaning on our collective experience over the last 4 or 5 years. And finally, because I like to end things on a positive note in this space, I'll leave you with one last small silver lining to all of this. I personally have to say that it's been nice to see Canadians rally behind one another over this trade war issue. You know, it feels like it's been a long time since that happened. And it's been a great reminder that even though we may not always agree, at the end of the day, we're all playing for the same team here, right? And hey, America, can we just be friends again? Please? I really want to go to New York this year. And hey, if you want to be friends, more specifically house buying or house selling friend, you can reach me using the contact information below, or you can use the link in this video's description to access my calendar and directly book a discovery call to chat about your real estate goals. That'll do it for this month, everybody. As always, I appreciate you. I'm Serge Papineau with the Papineau Group in Ottawa. Thanks for watching, and we'll see you next month.